The Chinese currency, we're going to talk about it because for a long time it was stable. Too stable, suspiciously stable, says Jeff Snider, the head of global research for Alhambra Partners, until very recently. And on two specific days in October, the Chinese currency moved. If you don't live in China, if our show is not being seen in China because it's blocked, whatever, China's currency represents more than just what's happening in China. It's a window onto the monetary conditions that affect all of us worldwide. So let's get right into it. Jeff, tell us, first of all, it was a little bit suspicious, and then tell us about the two recent days when something happened.
Well, it's like anything else in nature, right? You never want to see a straight line because anytime you see a straight line, that kind of indicates some kind of man-made manipulation. And that's obviously true when you ever look at any market chart, no matter what it is, currency, stocks, bonds, anything. There's usually quite a bit of movement, day-to-day movement, even seemingly random movement. Yet for the Chinese currency CNY going back to mid-June, kind of suspiciously lack of movement, narrow range, steady narrow range, as if it was being manipulated into in between 650 and 645 on the high side, which kind of raises our radar because we've seen this happen before. And as we talked about previously, the last time we saw it happen before, it didn't mean anything good, and it didn't end well either. So Chinese currency, lack of volatility, kind of a suspicious movements. We're already thinking about manipulation and official policy. And then, of course, why would there be manipulation in official policy that prefers a narrow range for the currency?
Jeff, remind me if I have this correct. Now, the first time we've seen it lots of times, but at least since the $0 crisis began, I think the first time we saw it was in 2008 or 2009 when the currency went just dead straight. It went dead. It didn't move. It didn't trade seemingly. And then it started to rise afterwards, signaling that the currency and money is being created worldwide. So we thought until about 2014 when it started to wobble, turn down. And then you're referring to the most recent period where in the summer of 2015, I believe, it was again very suspiciously flat, and then it broke lower. And so that's what we were worried about this time, right? It's suspiciously flat because maybe the PBOC is performing things not above the table. It's below the table. They're doing something to keep the currency stable. They're not getting enough money in, but they don't want the currency to devalue.
Yeah, there's a term for it. And you're right. It goes back to 2008. It's called contingent liabilities. Although in 2008 and 2009, the Chinese essentially pegged their currency to a specific value, which they had been done previous to 2006 anyway. So it was sort of like, okay, maybe they're going back to the same policy they had used before. But you're right. Whenever you see that happen, that's a warning sign that something's not going the way it's supposed to. And we start to think about that term of what's going on behind the scenes, stealth intervention. Is called contingent liabilities. It really means forget it. You're never going to know. The Chinese are never going to tell you. They're never going to report on any kind of form or international data. So we just kind of have to work backward from the realization, observation that the Chinese currency isn't moving, so something else is going on. We need to look elsewhere for what that might be. But as you said before, that kind of changed around October 13th, where suddenly expecting maybe that CNY would become weaker because that's usually the trend when one of these ranges breaks. It usually breaks lower, but in this case, it broke higher on October 13th, and then of course on October 19th, it went way higher, based on some other things going on that were not related to obviously the prior range.
So in the prior range, the officials in China were buying time because of something. That something I'm going to say is there was not enough international dollar creation, perhaps by money dealers, and you specify why that may have changed on the 13th and 19th in your article, which is titled, "While the Fed Chases the Unemployment Rate, ticks Euro-dollar deflation case is unusually unambiguous," posted on the 20th of October, 2021 at Alhambra Partners. So what was it that changed specifically on those two particular days?
Well, it would be a hell of a coincidence if it was something else. But on October 13th, number one, the Treasury Department announced that they were going now that they're free from the debt ceiling, they've got a couple month reprieve. they're going to start issuing cash management bills in a bucket load of cash management bills, between 175 and 250 billion of additional bills. And as we've been saying all year, this theme for, the mainstream media's theme for this year has been all wrong, which is kind of the point of our episode here, which is that, everybody's inflation, too much money, things are going in the right direction. We've been saying right from the start of this year, wait a minute, hold on. This treasury bill scarcity is a problem, and it's going to continue to be a problem. Rising deflationary potential, not inflationary potential, and all the dollar behavements, movements, whatever you want to call them, all that stuff has been backed up by data as well, as we're going to get into here, including this short run deviation, which is the Treasury Department reversing course for the first time this year and saying we're going to issue a lot more bills. That was the 13th, they announced that. And then on the 19th was the first of those actual bill sales, those auctions, which was 60 billion in 42-day cash management bills, in which, the demand for them was overwhelming. I think it was something like 182 billion in bids for that 60 billion in cash management bills. So, there's huge appetite because, again, as we've been saying, this collateral scarcity, which is a deflationary tight money condition that had developed the entire year so far.
Now, you mentioned one of the reasons. Right now, in your article, you mentioned two. And I'm going to use this opportunity to raise one of my all-time favorite pieces by David Parkins, our illustrator, of Dolly the sheep, right? If you remember, Dolly the sheep was cloned, except in this case, it wasn't scientists that had Dolly the sheep. It was bankers. And what did the bankers do? They put Dolly in the middle of a bunch of mirrors. And these mirrors represented rehypothecation, multiplication, repledging. And that's the other part that was missing, Jeff. Yes, Treasury Department, low supply, but guess what? In an expanding, happy world of economic activity, the money dealers would have stepped in, grabbed what collateral there was, and multiplied it. Even if they weren't multiplying it, you explain what they would have done.
Oh, you just did. I think that's really it. We can get into the complicated details behind it as we have before, but I think, for the sake of brevity, we'll just say that you're absolutely right, because as the Treasury supply of especially bills has been constricted throughout this year, what should have happened, because that represents a profit opportunity for money dealers, is they should have done more reusing, more repledging, more rehypothecation to make up that shortfall, because there was a profitable opportunity to do so. And quite clearly, they did not do that. So you're right, Emil, we actually have two deflationary problems. One is Treasury supply, which over the last couple of weeks, the Treasury Department has done a little something about, at least for the next couple of months until the debt ceiling comes back into play in December. And the other part of that is, which is probably more important, in fact, it really is more important, as we've seen consistently through history, is that dealers have been absent from trying to make up this shortfall in supply. Regardless of supply, dealers should be expanding the collateral multiplier, which, as you said, sort of clones collateral and redistributes it throughout the global system. So the lack of dealers doing that contributes to a tight money condition, which, if we bring this back into the Chinese context, that's one reason why we've seen, first of all, the Chinese yuan rise as if, completely unalterable up until January this year, when we started talking about bills and bill supply got restricted. Then it's sort of gone sideways overall for the year. It certainly has stopped rising, but leading to this June to October period where it almost traded directly sideways. So consistent with the overall picture of collateral short T-bill scarcity, lack of dealer activity, multiplication probably didn't happen. That's when we've seen CNY change, which is all of these things indicative of the same thing, which is tightening deflationary potential money.
All right, so we've seen that on the graph. The CNY flat, then spike coincides with those particular dates, important dates, meaning a loosening of conditions for some period of time. Now we're going to get into the Treasury International Capital Report, which is the TIC in the title of your piece, TIC. We're going to first look at the Chinese situation and then look more broadly, globally, at what official institutions are doing, as well as private actors regarding treasuries as well as other US dollar assets. The Treasury International Capital Report is 2 months behind, but Jeff, we're looking at right now, what are we looking at? We're looking at treasury holdings by the Chinese, by the Belgians. And we see that it was from September 2020 until January 2021, we saw a rise, reflation, reopening. After that, it turned down. Tell us why these charts are important.
Yeah, as we expect, just overall sort of general tick data interpretation, when we have more money sloshing around through the world because, or at least less constrained money, as the Eurodollar system is in reflation, which means there's less of a dollar shortage out there, we expect a couple things to happen as it relates to tick and just in general. There's more dollars around the rest of the world, so we see more dollars end up in these various hands, including US Treasuries, because if there's more dollars out there, more of them end up in the official Chinese pockets, which then get reinvested as reserve assets in US Treasuries and other US dollar types of asset classes, which is exactly what the tick data attempts to track. So consistent with not just US Treasuries, but all US dollar assets, reflation, more dollars outside the US. Therefore, foreigners tend to buy and hold more US Treasuries and more US dollar assets. And that's what we saw, as you just said, Emil, from September last year till January this year. A few more treasuries showed up in mainland China's hands and Belgium, but not really all that much. Certainly not the same degree as we saw the CNY rise, which went from 720 to the US dollar all the way up to about 640, 650,
Yes.
something like that.
Yes.
So I mean, CNY went up in a straight line to a degree that didn't quite match the little amount of treasuries, a little amount of reflation indicated by the tick data. But regardless, we get to January and something changes. Not only do we have CNY no longer rising in general, now we have U.S. Treasuries starting to trickle out of mainland China as well as Belgium. And Belgium, by the way, is just Euroclear, which means China depositing treasuries for these contingent liabilities, derivative transactions, whatever they may be. So Belgium is sort of a proxy, an offshore proxy for what China is doing too, in terms of the tick data. So January, something changes, and that's really the point. And ever since January, not only has CNY changed its behavior, we've also seen these first a trickle of treasuries outside of China and Belgium. Then when we get to when CNY is in its narrow, suspiciously narrow range, where we're almost certain there's contingent liabilities going on, manipulation. What the tick data shows in June, July, and August, we're only up to August in the data, but in June, July, and August is that treasury, the trickle of treasuries out of China and Belgium accelerates into not necessarily a deluge or a flood, but it accelerates significantly, which suggests that the Chinese actually were doing something to manipulate CNY to make sure that it didn't fall during that period, which then leads us back to the tightness, global dollar money, collateral issues and things like that.
And why might that be important? It's because, as the thesis of this show is, that this shadow money makes the global economy go round. And in the chart where you show Chinese GDP, we see the inflection happening right at that exact same time. Right when the money stopped flowing in so earnestly, did we see the Chinese economy start going sideways. And I believe the latest data is along those same lines, right? For August, September, fixed asset investment, retail sales, and industrial production, lousy. But I guess going forward, it may be better. But before we get to the future, let's talk about what we also saw from other official institutions, not just the Chinese. And so here we have another graph from the tick data where it's a 6-month cumulative change in official holdings of US Treasury bonds and notes. And here, I have it highlighted. It says, I need to read this out. It bears repeating. Official selling is as I described above, essentially a consistent, historical grounded. I'm messing it up, Jeff. Jeff, you tell us what this graph means then.
Yeah. There's this mainstream misconception that when foreigners, especially foreign governments, are selling their treasuries because they hate the U.S., they hate the president, they hate the dollar, inflation, treasury market's going to blow up. I mean, all of these things that have been thrown around that are completely falsifiable, and in fact have been proven they don't match the data, which is that when foreign, especially official institutions, are selling U.S. treasuries as reserve assets, it's because they have a reserve problem, which is a U.S. dollar problem, as we've been saying, tight money. So those two things correlate almost exactly. We see official institutions sell more and more of their reserve assets when there is a dollar shortage position. which makes sense, right? If you're a country and you have a dollar short, which means you need dollars constantly, and the euro dollar market is not supplying them on at the rate or the cost or in the supply that you need, you have to do something because you need dollars. And so, as we just said, the Chinese are selling their treasuries to try to make up for the dollar shortfall, which shows up in the Chinese yuan acting very differently than it did during reflation yuan and reflation treasuries. And now we're saying that it wasn't just China, this was a general problem. So there must have been a dollar problem globally, not just in China, that forced these reserve managers and these reserve institutions, whether it be central banks or governments around the world, to likewise have to begin selling their treasuries again. Again, it's not because they hate America or the dollar. They're not afraid the dollar is going to crash. They're not even afraid of inflation. What they're doing is trying to make up for a global dollar shortage, which is the consistent theme in all of the data and all of the market behavior this year. So what we see from the tick data in terms of official selling is that in August, for the first time, the 6-month cumulative total turned negative, which is throughout the last, more than half a decade, is a significant and solid signal of a dollar shortage situation arising. Not too much money, not inflation, not growth, not acceleration, but the exact opposite. And it's been consistently that way. So officials selling treasuries, mobilizing reserves. The reason for it is not enough dollars globally.
We were just talking about official institutions, but you continue to make the point that we saw the same sort of behavior by private market participants. And in the next graph, what we see is public and private combined buying US assets, not just treasuries, you say, but also other assets. What are we to take away from this graph? Confirmation? Corroboration?
Not just confirmation and corroboration, but spilling over wider and wider and wider. You see, we started with the narrow sense, it's just China. China's having reserve problems, CNY. And then well, no, it's not just China. It's all official reserve sector because they're selling treasuries too. No, by the way, that's not just the official sector. It's also the public sector. When we get to May and July in the tick data, which are negative months for those, as you said, Emil, that's both public and private are selling US dollar assets, not specifically just US treasuries, but all US dollar assets, which is an abnormal behavior that is constantly and consistently associated with dollar shortage periods. So yes, what we're saying is it started out sort of maybe narrow, and over the entire year, it's gotten progressively worse and worse and worse to the point that we get to the summertime, it's not just China and it's not just officials outside of China, but it's pretty much the entire dollar system is saying, as Urjit Patel, the former Reserve Bank of India governor, said back in 2018, dollar funding has evaporated. I think evaporate is probably too strong a term. I still believe that, but dollar funding is a problem. There's not enough of it. It's causing issues throughout the global monetary system, which is going to be a problem for the global economic system. And as I said at the beginning, this is the exact opposite of the theme for this year, which is everywhere else in the mainstream media is all about inflation and too much money. When we have a very consistent, concise, and very neat and tidy package, unambiguous picture of market behavior, data, dollars, economy that all say that the opposite is increasingly becoming the case.
You have several very nice summarizing paragraphs in this report, but I don't want to read them out. I encourage the audience to go to this piece and read it themselves. But Jeff, I guess now I'm going to ask you for your concluding thoughts, and then, well, I'm out of sorts. That's okay, Jeff, because it's an important piece. My thought is, whether or not it's in order, is this. That was for August. Guess what? The COVID case counts peaked in August, at least the Delta ones. I don't know what Greek letter we're on anymore, Jeff, but I think they peaked in August. Also, US Treasury stopped falling, yields stopped falling, prices stopped rising in August. Things have turned around, and now capital markets are saying things are more optimistic going forward. The debt ceiling will be solved. There will be more treasury bills. The Chinese currency is going up. Glory, hallelujah, Jeff Snider. I feel very optimistic about the future. We can talk about the future in part 2 if you want to, or do you want to summarize anything more about this episode?
Now, we'll talk about the future in part 2, including U.S. Treasury yields and what they mean, and other sorts of indications about since August, what is really going on and what, over the next couple of months, sure, there'll be more Treasury bills, but then we have the December debt ceiling come back into play, as well as a couple other things, including the growth scare and what that might do to offset any supply in Treasury bills with what dealers might end up doing as far as risk aversion and collateral multipliers and things like that. And we'll look for some clues in the yield curve to tell us what they're thinking already.
Let's talk about all that in part 2. Also, dear audience, if you know how to do an outro better than I just did, please let me know in the comment section so I can do so better on our next episode. Sweet Moses.